if I want to go milk a cow, I can, because I can. I don't know what to say. I'm not 50 Cent. I'm here to collect the rent from my tenants. I'm financially independent now. You can go out and milk yourself a cow. G'day guys, it's Nathan Birch here from B.Invested.com.au, the place where we help people build property portfolios and get to financial independence sooner so you can live a life on your terms and tell your boss where to go sooner. Today I'm here answering questions from Facebook, and if you're part of the Facebook community, well, I might be answering a question. If you're not, best to check out our Facebook page in the link below. Today I've got a question here from Rory Partridge. Question for Nathan is, what is your view on taking out interest-only loans with an offset account to either enable or increase the positive gearing on a property? Good question, Rory. Personally, when I first started investing in property, I used to think that you'd have to pay your property down. That's the only way that you can make money, and you should have everything unencumbered and not have any debt at all. But I realised later on that over time, any successful business or any successful investor or whatever all has a level of debt attached to their portfolio or their business or whatever as a part of leverage. And whilst when I look at a property portfolio, I look at that and think, okay, we live in Australia, Australia's got debt to it, New South Wales, where I'm from, Sydney, New South Wales government, they have a lot of debt too, and it's something that you need to manage it well. And for me personally, I wanted to make sure that if I was buying a property, that if I was to buy it 100%, I'll rephrase this. If you've got a 20% deposit, for example, you can put that on your property, but if you're going to be taking that out of savings, you could be earning an interest on that, and you've got to look at that and factor in the opportunity cost, because otherwise you're lying to yourself about a property being positive cash flow neutral or negative cash flow. So with it, when I buy a property, I always make sure that the property will stand on its own 2 feet, have its own heart, lungs and respiratory system looking after itself from day one, making sure that the cash flow will look after itself and it won't be eating into your lifestyle. I normally work that on either an 80% or 100% finance. Your 20% deposit or your 5% deposit or 10% deposit, that will have an opportunity cost. That money can be earning you an interest, or it can be costing you or saving you from having to pay an interest. So personally, I look at it from when building a property portfolio. If you want to get 10 properties, for example, my goal when I first started investing was to get 10 properties, so I could build a property portfolio, have a passive income and be able to retire and exit the workforce. And for me, when I first started investing, I was on, I think, about $35,000 a year, $40,000 a year. It was early 2000s, and I thought to myself, if I was paying an extra $50 per week off a property, that would be $2,500 per year. What I realised later on is if I had 10 of those properties and I was paying $2,500 off a year, that's $25,000. That's nearly all my income that I was earning. So what I need to look at is, how would that cash be better spent? So there's different phases through property portfolio that you go through, and the first one is like education, and that's what a lot of people do on YouTube and Facebook, and why I'm answering the question, to help educate and bring on that knowledge. And with it, when you go through that education phase, you go out there and accumulate properties, and you go out just aggressively buying, and through that phase it might be a year, might be 2 years, might be 5 years that you build that portfolio up. It's a matter of accumulating properties so you can walk them through a property cycle, and then after that it's a consolidation phase, which is where you'd actually go out there and build your passive income stream from the assets that you're holding. It could be from adding a granny flat, it could be from renovating a property, it might be from pulling out equity and buying another property, which would be a complete positive cash flow thing, like a block of units or something to that sort of extent. And it depends which phase of property acquisition you're through, because in the early days, if you're buying 10 properties and paying $50 a week off each one, that's $500 a week out of your pocket expense, which really isn't going to pay down your loan anytime really sooner. It might shave a year off your loan at the end, or a month or 2 months or whatever. But the big thing is building that property portfolio. Personally myself, I'd be looking at $25,000 a year on that property portfolio of 10 and going, there's another deposit to buy another property, and be using it that way in the earlier phases. If it was a point where you're going, okay, I want to pay down some debt, I want to reshuffle my portfolio around, sell off some of my properties that have had good capital growth, pay down the loans, have a unencumbered property portfolio, or buy something different or whatever, then at that point it might be where you could funnel some cash in and knock out some of those loans. So everyone's at a different phase. My portfolio today is different where it was 5 to 10 years ago, and for me today it is different. It is more about reducing debts and all that sort of stuff. I've got a very low LVR as it is because I've bought all my properties below market value, which has helped and meant that I haven't had to go out there and pay them off because they've already had an inbuilt equity from day one. So whether it's all personal situation and it's something, there's no right or wrong answer. Personally, I like having interest-only loans for the first 3 years or 5 years, or whatever the bank will lend. But over time, once that interest-only period finishes after 3 years or 5 years and it turns to principal and interest, I don't go back and renegotiate and keep it interest only again. I just let it start paying itself down, because with my properties, they could be neutral cash flow from day one. In 5 years' time, when it turns from interest only to principal and interest, the rents have gone up. I'm very active on my rents, and I'm very active on making sure my property managers are very proactive to increase those rents for me. So if something's neutral cash flow today, it goes up $20 per week each year for 5 years, it'll be $100 positive cash flow per week in year 5. It turns to principal and interest, they start taking out $50 per week. I'm still positive cash flow, and I'm paying down the mortgage at the same time. So I hope that helps, and yeah, if you've got any other questions, feel free to post them on the bottom of this YouTube video or ask on Facebook with the link below. And thanks again for watching, and we'll catch up soon. Are you looking to invest in property? If you do, hop onto YouTube, watch my YouTube station. Is financial education your destination? That's alright, subscribe to my YouTube station. I don't know.